Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Today we have Mr. John Pennington, co-founder of a $28 billion family of investment funds. John, welcome to the show.
Hey, great to be here, Weston. Appreciate you. Thanks.
Of course. Yeah, so let's go into your backstory a little bit. Like, what drove you to start the investment fund in the first place? And then what opportunities did you see in the real estate space?
Yeah, good question. Really good question. And again, thanks for having me on the show. I really appreciate it. So it was 1999, and I'm exiting a prior business venture that I've been doing it for about 9 to 10 years, and I watched this report on the newscaster, and they're vilifying these fund managers out of New York for paying low taxes and making lots of money. And I was like, hey, I would like to be one of those guys. I would want to vilify those people. So it was 1999. I started learning, really what a hedge fund was, what an investment fund was. And I thought, I think I have the personality. I think I have the skill sets to be one of those people. Anyway, it took me 5 years. And I did, during that time, got Series 7, sold mortgages for a while. I wanted to learn about it all, but reading many private placement memorandums, many limited partnership agreements, I realized this is where I wanted to be. And I didn't launch my first fund until 2004. So it was a 5-year journey. One, because there was no tutoring, there was no classes, there was no hedge fund manager in New York that I could call and get tutored by. It was just, you had to learn it. You had to just learn it on your own. And so I did. And it took me that long to have the confidence that I knew enough that I could actually launch my first fund. So yeah.
That's awesome. Yeah, so talk about your early days when you were finding partners, you were finding deals. What did you do to raise money to start? And then how did you find the deals that you were investing into?
Yeah. So my first 2 funds in 2004, and we launched the second fund in 2007, was we were doing commercial short-term lending, 1 to 6 month type loans. This is what kind of happened. And I didn't really realize the market was there. When you go drive down the street of your city and there's check cashing stores, people need just a little bit more money for a week or two. Well, that's the same thing in business. Business people, okay, imagine a dude, he builds houses, right? And he has enough money to build 10 houses, but he doesn't. He builds 15. He has enough money to build 10, but he builds 15. And so many months down the road, he realizes, crap, I'm going to miss payroll next Friday, and I've got to get a loan. And so my business was based around people, just like check cashing stores, businesses get in financial crunches. And so our business model was, listen, we can get you a loan for 1 month or 6 months or whatever to get you over a bridge. And it was called Bridge Loan Capital Fund 1, and then it was called Bridge Loan Capital Fund 2 in 2007. And so we would do this for equity, not equity. I'd say debt financing, but it was asset-backed financing. So this guy who builds houses, he needs $250,000 by next Friday for payroll. He would have to put up a real estate collateral. We would take a first deed of trust position on it, charge him some points and some interest, and then he could take that money and pay his payroll. Or someone who was running, a big business and they were selling lots of products to Costco or Walmart, but they were on a net 60 and they just needed a bridge for 60 days. Same thing, the owner of that company would have some type of real estate. They would give us a first deed of trust position. We would then give them the loan. They could keep their business running until those payments came in from Costco or from Walmart, and it was it was a bridge finance. That's why it was called Bridge Loan Capital Fund. But it was based upon asset-based lending. I had to have an asset that if you borrowed money from me, Weston, and the day you borrowed money from me, you for some reason got hit with a bus and died, I could still eventually get my investors whole, right? It didn't depend upon you being alive. It's better if you're alive because you're going to work, and pay me back. That's better. But the in the risk parameters, in the risk matrix, if you died the next day, eventually I could still get my property back, sell, or get your property, sell the property, and get the money for my investors. And that was our first couple funds. That's kind of how we started. The way we, I'm a good money raiser, but I'm not a great money raiser. And so I knew this about myself, and I needed a personality that was a natural fundraiser, a natural salesperson, someone who loved talking on the phone. I don't really like talking on the phone that much, right? And so I found this gentleman, and we started our first fund in 2004, and he was pretty much in charge of raising capital, and I was in charge of everything else, kind of thing. But when you're a small company, you do everything. So every time he went and pitched, I went with him. And every time I went to go underwrite a 32 acre piece of property, he would come with me, right? And so we were like hip, attached to the hip for a couple of years there until we got more partners in and diversified. But so we would just pitch and deploy money, and pitch and deploy money. It was crazy. And then one time he came to me. We were in Salt Lake City, Utah, and the Utah Jazz were having the NBA teams were having a pretty good couple of years. And he said, John, we have to buy these executive suite tickets. And I said, what for? He goes, because we can invite people to come see the Jazz game, and they're with us 3.5 hours. And so this executive suite's got the dinner, it's got the halftime desserts, and you're sitting there in this box. And we didn't have the money, really. But we swiped some credit cards and got the money to buy these season tickets. And so, like, you're driving down the street of your city, there's a huge building there, like bank of something, and there's a president at the top of that building on the top floor. We would call that and say, listen, you always talk to a secretary or assistant, and you say, listen, your boss doesn't know me, all right? But I have 4 tickets to the Utah Jazz game playing the Lakers, Kobe Bryant. And this is this Friday night. It comes with a dinner, everything. Me and my partner, we would like to take your boss and his partner or her partner to this game Friday night. Would you please get this message to them and let me know if they would like to join us? And so if you just call up someone and say, I want to talk to your boss, you might get through, you might not get through. But that message I leave, she's going to get fired or he's going to get fired if he doesn't get that message to his boss, right? There's a Jazz
Yeah,
game.
because no one else does that.
Yeah, that's right. I've got Jazz tickets against the Lakers this Friday night. Even though maybe he can't go, then at least the message is going to get to him. And that's how we, one of the ways that we raised capital through that first couple of years as we grew our fund,
Awesome. So you started on the debt side, which seemed a little bit safer, and then you started doing acquisitions, and your company really seemed to grow through that.
Yeah.
So talk about the transition between the two.
Well, it wasn't too hard because the market made us. So in 2008 and 9, the whole country did this, right? And so you couldn't lend to people anymore in 2009 because they couldn't pay you back because banks weren't doing loans. You could not get a loan from a bank. Banks were like in a freeze mode, right? And so you had to pivot. So my third fund that we launched was an acquisition. We were acquiring REO from banks mostly, or loans from banks, and then foreclosing on them. So you'd call up a bank and say, "Man, what do you really want to sell?" And they'd say, "We have a 784 unit apartment complex in Dallas, Texas." And okay, what do you want to sell it for? Is it an REO? Did you foreclose on it? Where is it? And then we would have our fund go purchase that 784 unit apartment complex, and then we would fix it up. It was always value add, and we never bought anything unless we thought or we knew we could value add and increase the value of that property some way. And so we were always looking at something that it was financially distressed, it was physically distressed, it was they didn't do advertising very well, they didn't have very good loans, whatever it was, something that we could change, do that. And so that's when we really pivoted to acquisitions. And truthfully, if the Great Recession had never happened, I would probably still today I'd be doing loans. But in when they tell you that when there's calamity, there's opportunity, there was calamity everywhere in 2009, and that allowed us to jump further in and take advantage of the market. I had friends calling me up 2008, 2009, and they're saying, John, how you doing? And I said, I'm doing great. What do you mean? And they'd say, well, we know you're in real estate. We know real estate's really bad right now. We just wanted to call and see how you're doing. And I said, have you lost your mind? Are you crazy? In 100 years, this is the best time to be in real estate. And see, they were thinking it was the worst time. And I was going, you can't buy stuff cheaper than you can buy now. And so some of those guys that called me, they eventually became my investors. People that felt sorry for me that I was in real estate, after about an hour on the phone, they're like, where do I invest? And they started writing out checks and investing with us, right? After I shook them by their ears and said, don't you understand what's going on? This is a 100-year dip in the market. You're never going to buy stuff cheaper than you can buy right now, and it's not going to last. And so we took advantage of that. And then my partners, who are brilliant, the partners that we had brought on that really knew real estate way better than me, we just kept raising capital, raising capital and deploying, and that just took us off. And if you take that year and when we pivoted and say, okay, that company alone had 0 assets under management starting, January 2009. Okay, by summer of 2021, we're managing $28 billion assets under management. We have 1,000 employees in 33 states, and I've got 32 partners, and that's a phenomenal growth, right? And then a year later, 2021, summer 2021, we had $28 billion assets under management, and then that summer we went public on the New York Stock Exchange, and so it's just a fantastic. And I retired a month after that. I was on for one more month, and I said, you know what? I'm done. I'm good, and let my partners go. And anyway, it's been a fantastic ride. Yeah.
That's awesome. Yeah. Congrats on all your success, by the way.
Thank you. Thank
you.
Yeah.
Talk about the transition from syndications to funds, raising for one deal versus raising a fund that goes and buys multiple deals. At what point did you start doing that?
Yes, it's if you have so I started in my lifetime probably 14 businesses, and all the prior 13 have the same problem. They get to a certain level and you can't scale them. They just don't scale. It's like a dentist who drills teeth every day. He can only drill so many teeth a day, and then he's topped out, right? But if he wanted to scale, he would drill on teeth 2 days a week, and then the 3 days a week that he's got left, he would go out and try to start purchasing other dental offices so he can get after 10 or 15 years, he might own 60 dental offices. But he would need some kind of format, a structure to do that. And the general partnership, limited partnership structure is the easiest thing to scale I ever saw. All my previous 13 businesses would get to a certain level, and we were like a dentist. We just couldn't scale. It kind of just, it was hard. And then once we started the fund model in 2004, it was like, it scaled by itself almost. And if you pushed it, it scaled really fast from 0 to 28 billion in just, 16 or 17 years, something like that. So, so what I'm trying to say to you is when you have that mindset, okay, I'm a dentist and I'm not going to drill teeth all my life. I'm going to actually own a bunch of, so you push your investors to say, yeah, we can do a syndication deal. Like in real estate, you're doing a syndication deal. You're getting one investor, two investors for this deal, and one and two investors for this deal. And then, but eventually we're going to be a fund. And as you transition to a fund, you kind of take those old investors and you go, look, guys, I can't knock on doors and raise money for every single deal. It's wasting my time. I'm out finding great deals most of my time. But in syndication, you spend half your time going back to investors and selling them every time you want to raise on a syndication deal. And so what I'm trying to say is when you're in the business and you're going big, it's a natural evolution of your business model. You just can't spend that much time, of your day raising capital. You have to raise capital once and go out and buy 10, 15, 20 properties rather than find a property, go raise capital, deploy, find another property, go raise capital. So you can
spend a lot more time actually finding the better deals rather than raising the money.
That's what you should be doing, because that's where the money's made, right? And so what happens is in the beginning, you tell your investors, listen, if you want me and my partner's talents, you're going to have to come into the fund, and some resist, and you're going to lose a few. Some won't do it, but most of them, after they've been with you for a while, watching these syndications, they get confidence in your abilities to make them money in this asset class, and then they convert over to the fund model. That's usually how it happens.
Yeah, because you definitely need to have a track record to start the fund.
Yep.
And I've talked to a lot of fund managers that came from syndications and now they're doing funds, and it's like way harder to raise money for the fund. So when do you think you should transfer over to the fund model?
Yeah, so no, you're right. Getting someone to a fund is more difficult than a syndication, okay? But it's worth it, okay? Because that money is with you. You can roll rather than just roll on a syndication deal. So it's when it's at the point where you don't have enough time. It's at the point where you say it's not a sales pitch. It's reality. You tell your investors, guys, I can't do this anymore. I cannot do syndications anymore. And sometimes you allow your investors for the first year or two. If they have $1 million, they can put half. Like when you go buy a property, the fund's going to buy a property, okay? So the investor can put half of his 1 million into syndication, but he has to have half of his million in the fund, right? And so you prove to him over time, a year or so, that it's much easier just doing the fund. And then after a year or so, you tell him, we're cutting it off. We have so many investors coming in, we can't do half and half syndications anymore. And that's kind of how you transition your investors into the fund model. It's difficult. I agree with you, but it's the only way really to really scale.
Mm-hmm. Did you see a change in the type of investors, for example, like individuals to family offices to institutions, between the syndications and funds?
Yeah, our goal was always to get to institutional money, but we never left the high net worth individuals or the family offices. I think my last year I was, before I retired, that year we sent out 225,000 K1s. You know what I mean? That's a lot of K1s to send out, right? But we had we always still have a mix of large institutions, mid-sized family offices, and individual high net worth individuals. We have a mix, and some funds don't do that. They eventually just go all the way to institutions. But we found that was not a good model for us, for a lot of different reasons. But so when we started in 2004, I kept looking at my partner and I kept saying, listen, you and me we both know that we're not smart enough to run a big company, but I want this to be a huge company. So we have to get talent in that's smarter than us. We have to bring them in, give them GP ownership, that they are an owner, that they're not going to leave, right? And then just scale this thing. And that was our model. We weren't afraid of talent that was smarter than us. We were more focused on how can we get to institutional money. And so my first fund, 2004, we didn't get our first institution, I think, until 2010. It takes a while to be worthy enough for an institution to write you a big check. And institutions, they don't fly out to see you unless they know they can deploy $30 million with you. And they don't want to be the biggest, guy in the room. They want to be like, if they want to know you have $100 million in your fund and they're 30 million of it. They don't want you to have a $35 million fund and they're 30 million. They usually don't want that. And so you have to be around for a while to be worthy to get these, institutions to fly out and see you.
Mm-hmm. Talk about finding partners to expand into different asset types. Like, for example, you expanded into development, to industrial, to office, all these different asset types in real estate. Yep. How did you find those partners, and how did you provide the platform and the opportunity for them for a more entrepreneurship role, because they were coming from a salary role, likely at a larger corporation, into a more entrepreneurship position.
Yeah. So on the onset, way back when we first started, first couple of years, we imagined this dude or lady, okay? She or he, they've been to an Ivy League school. They graduated with they're very, very smart. They went to Wall Street. They've been on Wall Street. Here's a good example. They went to Wells Fargo and they worked at Wells Fargo in the underwriting department for real estate. They've been there 17 years, okay? And we imagine this person is underwriting, 800 unit apartment complex loans. Okay. Now, John Pennington, I can do a 20 unit apartment complex. I know how to underwrite it, but I do not know how to underwrite a 1,200 unit apartment complex. I don't know how to do it. I need that talent. Okay. So how do I get that talent? Where is it? Well, I believe that it's at Wells Fargo somewhere, and this guy's been there 17 years. So I imagine this dude in my mind, he's driving to work every day, driving home, or a lady driving to work, driving home. And you know what they think about every day? One day I'm going to start my own fund. One day I'm going to start my own business. They think about this every single day. And so if I find this person, I say, listen, you've been doing this 17 years. We need your talent. We are going to give you a slice of the general partnership. You're going to be an equity owner. What I'm trying to say to you is, when you're 70 years old, don't be one of those people that says, I should have tried an entrepreneur one time in my life. I should have tried to be my own boss one time in my life. Don't be that. Even if you're 70 years old and you failed at that, at least you tried. Don't be the person that says, I should have tried. I'm giving you that chance today. You should quit your job, come work for us. Your salary's going to go down. I'm telling you, it's going to go down. But you're going to be an owner of the GP of this big fund that we're growing. If it works out, you're going to make way more money than you ever thought possible, okay? And so that's how we found talent. We found talent that we didn't have. So if we wanted to expand into industrial space, we had to find people because, look, an apartment complex, blue-collar apartment complex, is not the same asset class as student housing. People think it is. They think student housing at a college and apartments are the same thing. They're not the same thing. They are similar. And so we never really went into student housing because we knew it was a different asset class, even though we knew apartments. So if we were going to go into industrial space, we had to find some dudes or ladies that have been doing industrial space for 15 to 17 years. We had to find that they knew the ups and downs of the market. They knew all the tricks. And we had to find if that person had the same culture as we did, the work ethic, if we found those couple things, then we would say, hey, maybe we should expand our funds into more funds that just do industrial space. And do we have investors that want to put money in industrial space, not just apartments? And so that's how we kept expanding in a different, but there were years that we looked for. Industrial space is a good example. We tried to find people to go into the industrial space for, I think, 5 years until we found somebody. So you keep every year on your business model. Okay, this year we're going to launch an industrial fund, but we couldn't find the right people. And the next year, okay, on our business model, we're going to launch an industrial fund this year. Can't find them. It took us like 5 years of searching until we found the right team, the right culture, brought them over and launched that vertical of funds in industrial space. That's how we found them.
So how many people would it be per asset type? Would it be just one person and then they would recruit the team?
No. So the team, to launch a fund, our model was that we had to have at least like 6 people on the investment committee. So let's just say we were going to do dental offices, okay? Well, you have all this money in the fund and you're going to go out and buy dental offices and you're going to get loans from banks for dental offices and you're going to leverage, you're going to do all kinds of things. Well, you have to have a team of at least 6 people. And let's say you wanted to buy a dental office in Dallas, Texas, okay? The 6 people had to have some expertise in that model, okay? And so, and our model was you had to have 5 out of 6 votes to borrow money, to go to the bank and buy something, or to so you couldn't do 4 out of 6. And so all the owners could put a person on that team, and there was about 6 people. So you really couldn't launch. We didn't really launch, a new vertical until we knew we had at least about 6 people that could really scrutinize dental office deals. Now we've never done dental offices. I'm just giving an example. So, but you have to have people that know the dental office industry. You just can't find someone that's in apartment complexes and then they come over and start doing dental offices. That doesn't work, right? So that's kind of how we judged it, if we were ready or not, because those 6 people are the people you're going to sell to your future possible investor. Because the future possible investor is going to ask, that's a great thing. We're going to consolidate dental offices. Tell me about your team. And you can't do one person, because what if that guy dies in a bus accident, right? Back to the other example. You need 6 people-ish, and they all have to be kind of experts and have great have great track records in that industry so that I can go and raise money. And that makes it way easier to raise capital, because once you sell the thesis to an investor, then they want to know who are the people who are going to operate it and how is the company structured. And so that's way easier to raise capital that way.
Yeah. So what would be the advantage of, like, say 6 people go out and start their own investment fund? What would be the advantage of them working through you guys? And like, how did you provide the platform for them to build their own line of business?
Yeah, that's good question. So what usually happens is the people who, there's 3 circles in a fund. Three skill sets, and I'm really going to rough it. There's a circle over here, capital raisers. And that could be, I'm raising capital from a bank, which is debt raising, or from investors, which is equity. Capital raisers. There's another circle over here, expert investor. And there's the middle part, which is people who handle the SEC, that send out 250,000 K1s every year, that do the audits, that have SEC audits, that handle the IRS, that handle the quarterly reports, that do all the fund administration. That's the middle. All right. Usually the people who have the talent, let's say they work for some big, huge REIT, and they just sell like a $5 billion, they're employees. They sell a $5 billion portfolio off to a bigger fund, These 6 people, or 5 people, or 4 people, they believe we have the talent. Why don't we just go start our own fund? And look, money follows talent, So they go start their own fund, And so within a year or two, this is kind of, I'm really kind of telling you a true story, but within a year or two, these 5 or 4 people have only raised like $30 million, and they know they can't survive on, whatever little bit of money they've raised. They're not capital raisers. They're not SEC people. They're not IRS people. They're not fund administration people. They're the expert investor. And so the expert investor at some point realizes, wait a minute, we're missing pieces to really go large, right? And so our company, my partners, we know how to capital raise. We know how to debt raise. We know how to equity raise. We knew how to handle the SEC. We knew how to file in all the states for the securities laws. We knew how to do fund administration. All the things these guys don't want to do. Because expert investors in real estate, they love real estate. They love it. They love it. They love it. Love it. They don't want to do an SEC audit. They don't want to do quarterly reports. They don't want to go out and raise money from investors. They think they can, but when they really get into it, they can't. So you have to have 3. So like when I first started my first fund, me and my partner, we did it all. I raised capital, I did the middle circle, and I was the expert investor, right? And my partner, he raised capital, he did the spreadsheets with me, and we had to do it all. But as you get larger and you want to go really big, you have to specialize in your skill sets. And so that's kind of how people that are expert in their field. Let's say you have an expert that knows how to buy and sell biotech companies. He knows how to dig into a biotech company and figure out whether we should buy it, sell it, what price should sell it for. He probably doesn't have this circle or this circle, but he knows this circle. He loves it, right? And that's what he loves. And the people who love raising capital, the salespeople, they hate sitting in front of a computer doing spreadsheets for the quarterly report. They hate it, right? But there are some people who love being in front of their computer, doing all the accounting, doing all the spreadsheets, the balance sheets. They love it. And that's the circle they fill, right? So three different skill sets in a fund. And then as you grow, you just put more people in that circle, put more people in the circle, put more people in the circle. So we would have at least 6 people in this circle, expert investor, right? And we'd build out the circles with great personnel.
For sure. Yeah. So you provide the platform for teams to build out their line of business.
Yeah.
What would be the vertical? What would be the split between your company and the team?
Yeah, so
for the GP.
I can't really reveal that on my companies. I don't really want to go there, but I can tell you that it's always all over the place. It's always all over the place. I've seen other firms do it way different than we do it, but in average, when I've looked at all the firms out there, and this is a real average. It's not a mean. It's an average. Okay, so let me go back to averages real quick. Weston, I take you to this beautiful place, and there's lots of great looking girls here. Okay. And you're looking for a girl that's 5'6" tall, okay? And I tell you, in this room, there are 100 girls, and the average height is 5'6", okay? And you walk in there and you find out that 50 of the girls are 5 feet, and 50 of the girls are 6 feet tall, right? There is no girl in there that's 5'6", but the average of that room is 5'6". Does that make sense?
Yep.
Okay. So what I'm telling you, that I'm giving you the average, okay? An average is usually the expert investor people are around 40%. The middle circle is around 40%, and the fundraisers, the capital raisers, if they're owners, they're around 20%. Okay? But again, back to averages, you can walk in a room where there's an average height of women that's 5'6" and find out there's no women in there at 5'6". I'm giving you an average, okay?
Right. Yeah. So talk about your experience going public. I mean, that had to be an incredible experience going to New York and ringing the bell there.
Yeah. So
and what drove you to go public in the first place? Because you see a lot of funds.
Yeah.
They stay private.
Yeah. Yeah. At a certain point, when we first started my first fund in 2004, I sat next to my partner and I said, and our cost of capital back then was like 16%. You know, we were doing hard money loans basically, and if our loan worked out perfectly, our cost of capital was 16%. And I said to my partner, I think in 2004, 2005, I said, one day we're going to issue our own bond, and we're going to get the lowest cost of capital ever. And he said to me, "What's a bond, and how do you issue it?" Right? So again, back then, we had 2 different skill sets, right? And I said, our goal one day is when we start issuing our own bonds, we're going to be borrowing money at the lowest rates possible. And therefore, our cost of capital is the lowest rates possible. So at certain point, you get so large, 28 billion AUM, that you go, wait a minute, we're on this cusp of being able to be big enough where we can start issuing our own bonds. Meaning, you're always trying to get more capital, but you're always trying to get more capital cheaper. And so going public, it's never to exit, even though some people exit, like I exited, but I'm still a large shareholder. That's not a good reason to go public to exit. The reason to go public is to get to obtain more capital, because your business model can grow much faster, exponentially, if you had more capital. And so since we've gone public, we were at 28 billion when we went public. I think we're now 47 billion AUM, something like that. So obviously, once you go public on the New York Stock Exchange, it's much easier to raise capital. But during those last couple of years right there, we started to issue our own bonds. And we just needed larger amounts of capital, and we needed cheaper capital. And so that was the last couple of years right before we went public. I believe that was one of the main drivers. There's lots of drivers to go public, right? But a big driver is, can we obtain larger amounts of capital a lot cheaper than our competitors can. And so the people who aren't public can't get capital as cheap as we can get.
Got it. So if you were to start, I'm asking this for myself and all the other people that are starting their own funds and are in the early stages, maybe first 5 years. If you were to go back and start your fund again, what would you do?
So people ask me this all the time, and I really believe, you can learn about a fund in a book over and over and over and over and over, but the best way to learn is to launch. And the easiest way, I think the easiest fund to launch is an asset-based lending fund, because the loans are 1 to 6 months. So you have turns, right? And your asset-based lending, and so if I had to go back, or if I was young today and I didn't know how funds work, because look, after you start your first fund and you do like 2 or 3 loans, the first quarter you've got to issue a quarterly report, and every year you have to issue a third-party audited report to your investors. You're learning how to run a small fund so that you can become a big fund later. And so I would say to you, what I think the easiest fund to start is an asset-based lending fund. And you're lending to people who are in business. You're not lending to individuals. You're lending to a business that needs some type of bridge financing, but you're not lending on a handshake. You're lending on a collateral that if that person dies in a bus accident the next day, you can eventually, over months, get your collateral back and pay your investor.
Yeah, so you mentioned 1 to 6 months. What kind of returns would you expect? And obviously, it would probably scale faster than a fund where you're more long-term lending, because you give capital back to investors quicker, and then they reinvest more money. They trust you quicker.
Yeah, that's right. So back in the day, we were charged, and I don't think you can charge today because interest rates are much lower than they were back when I started. So we would charge 16% interest on the loan. So if you borrowed from us, you're going to pay 16% interest, plus you're going to pay 6 points for the loan. And people say 6 points, that's a lot of, this is my pushback back then. Listen, when you sell your house in the United States of America, the real estate agents, they take 6% to sell your house. They don't own your house. They didn't invest in your house. And you have 2 women or 2 guys driving nice Cadillacs, and one's going to get 3%, one's going to get 3%. You're still paying someone 6%, right? So you come into my office and you say, John, I need $250,000 by next Friday to make this payroll. Well, for me to have that ready to go, I already have to have done months and months and months of work and have this money sitting, making almost nothing in the bank, waiting for you to walk in. And when you walk in, I've got to take my whole team, and we have to, over the next 7 or 8 days, spend 10 hours a day to underwrite and make sure that your property is what you say it is, title reports, getting the loan docs together, getting a legal together. We have to do what a bank does in 2 months. We have to do it in 5 to 7 days. And so for that effort, for that, having that money sitting for those investors for months and months and months, putting that money in, we charge you 6 points. And it seems like a deal compared to what you pay a real estate agent, 6 points to sell your house. They've really done nothing up to that point except sign a contract and start trying to sell your house. I've done a ton of work. So that's how we justified it back then. And then we charge the borrowers. But if he's only borrowing the money for 3 weeks, he's really only paying 1% interest. Like if we charged him 12% interest, well, if he only borrows the money for 30 days, that's only 1%. Plus the 6 points, right? So it'd be 7% for 30 days. So the interest rate was not a real big factor to the borrowers, because they're not borrowing for 1 year, 2 years, 3 years. They're borrowing for 90 days, 60 days on average.
Yeah, that's very interesting.
Yeah.
So let's talk about your book. It's in the background, Dollars, Gold, and Bitcoin.
Yeah, Dollars, Gold, and Bitcoin. Available on Amazon.com and Audible.com. If you want to drive around and listen to my scratchy voice for 6 hours, you can go Audible.com. So yeah.
Yeah, talk about just briefly what is in the book. What can people expect?
The first half of the book, I talk about the strength of the U.S. dollar against the BRICS nations, the strength of the U.S. dollar against Bitcoin and gold. I talk about how the Federal Reserve has marketed the number one product of all time, the US dollar. And I try to convince my reader that the US dollar is a product. Just like everyone else has a product. Starbucks has coffee, the US government has the US dollar. And how have they, over the 100 years, how have they protected and promoted their number one product? Why is the US dollar accepted all over the world and other currencies are not? How did they make a product that prolific? Why can I almost go to almost any country in the world and hand out a $100 bill and they'll take it? But when someone comes to the United States and they hand out their $100 or $100 currency, no one will take it. How did the Federal Reserve do it? So if you can figure out how that product, the number one product, has created insatiable demand, has promoted and protected their product, maybe you could take that business model and in the second half of the book, turn it into your business. Learn from the Fed or learn from the US dollar how to make your product number one. Use all the tactics that they've used over the years as much as you can possible into the private sector. And so the second half of the book, I talk about how my partners and I, built a fund, how I used, and I didn't do it as well. I didn't write it as well as I thought I did when I first wrote it, that I made the transition from the first half of the book to the second half of the book. Because in the second half of the book, I'm really saying how I built my company. I learned really from studying the Federal Reserve. I learned it how the number one product of the world, the US dollar, became number one. And so that's kind of the premise of the whole book. Yeah.
Awesome. Well, cool. Any last tips for our listeners, John?
I can tell you one thing that when I get on stage and I do this presentation on stage about my book, the one thing I tell people is when I was about 18 years old, maybe 17, I'm not really sure when it was, I came up with this slogan that pushed me through my whole life to start my businesses and just keep going. And it was this. I looked into the mirror and I said to myself, John, you're not afraid of being poor and you're not afraid of being old. You're just afraid of being old and poor at the same time. And I repeated that to myself over all those years. Every time I had a business that didn't work or had to change business or had to pivot, I just said, John, you're not afraid of being poor. You're not afraid of being old, but you're just afraid of being old and poor at the same time. And that pushed me to live frugally, to always have a war chest off to the side in case I hit bumpy years, back and forth. And I can tell you this, from the start of my first business right out of college to me going, my company and me and my partners going public on the New York Stock Exchange was about 31 years, 32 years. And I did some calculations, and I don't know if you know this, but if you start, Weston, if we started counting right now, 1, 2, 3, 4, 1 second, right? To count to 1 billion seconds is 31.7 years. People don't really, they'll have to get their calculators for them to prove it because they don't believe me right now. But people misuse the word billion all the time. They say, John, I was outside. I saw this flock of birds. There must have been 1 billion birds out there. And I go, no, there wasn't. You know how I know? I've done the math. It's 31.7 years of seconds. So when I first started my first company, to me going public on the New York Stock Exchange and retiring, it was about 1 billion seconds, right? So I tease people. I said, I got rich quick. It only took me 1 billion seconds, right? So
it's funny.
I'm just saying, what I would like to say to you is the day you were born in the United States of America, or the day you moved to the United States of America, that's your lottery ticket for an entrepreneur. Now listen, I don't know. I don't think we're the best at math. I don't know if we're the best at anything, but if you're an entrepreneur, this is the best country to be in. The day you were born, the day you moved here, if you're an entrepreneur, that's your lottery ticket. There are people who move from Nigeria. They move from Thailand. They don't even speak the language. They move here, and in 3 years, they own like 2 restaurants and a laundromat. And you have people that are raised here that can't even keep a minimum wage job. It doesn't even make sense. So when my boys were in high school, I would tease with them and I would say, guys, walk up to an immigrant and try to convince that immigrant to work a 4-day work week. That immigrant will laugh in your face. They will just laugh. Why would I come to America and work only 4 days? Like all the Americans want to work, right? This is the land. It has, for an entrepreneur, it has financing, it has structure, it just has everything you need to be an entrepreneur. And so if you're an entrepreneur and you're in America, in the United States of America, you have won the lottery. And I just say, don't waste your lottery ticket.
Yeah, and it always provides you the opportunity. So
incredible.
Glad we're born here. So we take it for granted sometimes.
Yeah, they take it for granted. Yeah.
Awesome. Well, shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Mr. John Pennington, glad to have you on.
Thank you. Thanks for having me. Appreciate it.